Hi, Brendan.
Hi, Tom.
How you going?
Good. You can hear me okay, obviously.
Yeah, not a problem.
How you feeling?
Yeah, okay.
All right.
A little bit scratchy in the throat. Apologies in advance.
Yes. Well, yeah. Well, firstly, good morning to all our clients, and obviously welcome to another webinar update. As always, I've got Tom with us, Managing Director of Drummond Capital, and as you all know, is our asset consultant. But Tom was, I guess, found out this morning you got COVID.
Really unfortunately. So
Yeah. Yeah.
money never sleeps, Brendan. So the show goes on.
That's it. That's it. So we appreciate you being on board, obviously today. But we'll if the voice starts to go on you, you've got an out, mate. We'll let you off. All right.
The tea and the lozenges, guys. So hopefully it's all good for the next 45 minutes.
Yeah. Well, as always, Tom will be providing a market and economic update, including portfolio outcomes and the current asset allocations. And again, we want to make this webinar as interactive as possible. So if you do have any questions along the way, there is a question panel at the bottom of the screen that you can type away, and of course we'll do our best to get to all of those. But for now, Tom, I'll hand it over to you.
Thanks, Brendan, and thanks everyone for joining us on the webinar today. Lots to talk about given the interesting start to the year, and as Brendan mentioned, please put your questions in the chat box as we go, so you get as much out of it as you can. Disclaimer, which you've seen before, and just a bit of an agenda for today. So firstly, we'll take a quick overview of what's happened in markets and to global economic growth this year. Secondly, we'll sort of dive into the changes that we've made really to defend portfolios and sort of subsequent performance update. We've been quite active, as you've probably seen, and so what's taken place we'll recap on. We will have a bit of a look at the Russia-Ukraine conflict war, hopefully resolved soon, but we'll take a look at that and the implications, particularly as it relates to inflation and interest rates, which we think are the sort of two big issues really that are driving markets this year, more so actually than the conflict itself. Finally, we'll recap on equity valuations and earnings, and then we'll take a bit of a look at some of the changes we've made within the portfolios at a fund level, and obviously how the portfolios are then positioned going forward. After really solid gains last year for most asset classes, 2022 has been far more challenging. We'll talk more about commodities in the presentation. However, you can see here the strength in the oil price. It's up sort of 38% this year. Volatile over the last couple of sessions as there's hopes of a resolution or a peace treaty. And so that's sort of contributing to the interest rate and inflation story even more. So interest rate sensitive US equities, and in particular technology stocks, which are really sensitive to interest rates, are down the most this year. So the NASDAQ, which is all those big tech stocks, Microsoft, Amazon, etc., down 11.5%, having been down actually as much as 20% during the quarter. The Aussie market, the Australian equity market, is a little bit more defensive in nature just by way of its composition. Large blue chip stocks with the dividend yield, but also with the resources sector is benefiting essentially from the higher commodity prices, and so it's actually year to date basically square, so outperforming global equities, and the Aussie dollar, which so it's flat there, the orange line. This one above it is the Aussie dollar, which is up a couple of percent. So Australia sort of in some ways benefited from the conflict and what's going on in commodity markets. Emerging markets, the yellow line down here, down 8.5%, continuing sort of the pain that they felt last year as well. So it's been a tough place to be in an area we haven't really had much exposure, which has been good. Economic growth, despite all the headlines and the challenges, has been okay. It's definitely slowed from the fast rate coming out of COVID. And so this growth barometer, which essentially measures real-time economic growth across the world, the aggregate line, the black line's world growth, if you will, is at or slightly above zero, which means we're slightly above trend growth levels, which is fine. It's healthy. There's no recession. So despite the negative sentiment out there, it's not all bad in terms of economic growth. It's just slowed. And Asia, actually, the light blue line is now making a recovery. We're seeing signs of easing in China, and Australia particularly is doing much better as well. So the growth has really picked up post our sort of extended lockdowns last year. So let's take a look at what we've done within portfolios. So firstly, what's this chart? So the purple line is the total return of ASX 200 index since the start of December, and so it's up 2.8%, albeit with a few bumps along the way. The orange line is the world equity index over the same time period, which is down sort of 6%. So you can see the relative difference between the two markets since the beginning of December. And so, what have we done essentially? So just before Christmas, the US central bank pivoted their outlook for interest rates based on this persistently high inflation. I think in the webinars all throughout last year, we've been talking about this sort of higher and more persistent inflation starting to build, and eventually that was going to require a response from central banks, and now we've started to see that come through. And so, that once we've seen the policy outlook change, the market pricing for interest rates as well has changed, and I'll cover that in a little bit more detail. And that's then got broad implications for the portfolios across the board. So we've really gone from playing offense last year, and the year coming out of COVID was positive. We've been overweight growth assets. We've stayed, we've had small cap, maybe a little bit more kind of risk on environment, and participated in that growth. And I think when we had our webinar late last year, we were starting to say time to just start paring that back into the strength, because there were signs ahead that we were concerned about. And then late in December, we got more evidence of this playing out. And so we sold our remaining global growth manager, Munro, which owns a lot of those technology names, and that was good given what happened in the quarter to those stocks. We switched that into Australian equities, which you can see obviously over the gap has worked well in our favour. Right before Christmas, we reduced our Australian small cap exposure. First week of January, hopefully whilst you're all at the beach, we'd seen the bond market sell off, and so this is repricing the outlook for interest rates quite aggressively. And then once we saw that sort of happen, we got more concerned, so we reduced our growth to neutral, so we just basically sold global equities for cash. Then obviously the market sold off a lot through January, had a little bounce in half of February. We used that as an opportunity to sell more, reduce the final sort of exposure to small caps across the portfolio, both domestic and global. Small caps, smaller companies, less liquid, more susceptible in a difficult environment. You want to be up, blue chips where you want to be when the market's uncertain. And so we've removed all of that from the portfolios, and that's obviously.
Sorry, Tom, can you give an example of what a small cap type of company is?
Yeah, it sort of depends. In Australia, you're sort of talking about like maybe a small mining company, a lithium miner, or maybe you're talking about a little technology business under $1 billion in market cap, as opposed to like Commonwealth Bank at $130 billion. Like they tend to be narrower in terms of their revenue profile, like a single product or only one or two products, one or two customers, in a single market. They haven't sort of diversified the revenue and the risk around that. So they're growing really strongly. And so when the economy's good and the outlook's good, that's where you want to be, because they outperform the large caps because they're higher growth rates, but they've got more risk. The problem is when things get a bit difficult, they tend to underperform. People discount the outlook for the growth, and they're less liquid as well in the market that's got liquidity challenges, I guess. So the first thing you want to get out of. So we've essentially removed risky parts of the portfolio and raised cash early, and that's left us well positioned for the volatility that's come through post that, but also for what we can think is going to be a more challenging year than last year at least. So this is sort of month to date performance. We thought it was providing the figures. The final, we'll close out the month on Thursday, and you'll get your quarterly reports in April. But we can sort of give you an update on how we're going. So rolling 3 months really was just capturing the most of the sell-off. You can see across the board the portfolios are, preserving, doing quite well. And I think context is really important here. I know certainly feels like people are more concerned about what's happening in the world at the moment, probably as a result of it being a war or a proper conflict, as opposed to just market-driven volatility. And so I think I think a lot of people have expected that the outcome from a portfolio point of view would be much worse. But in context, a balanced portfolio down 2.7% is not much really, and it's in the realms of expectations over the long term, and it's also coming off the back of a strong 2021 in terms of total returns. And really, when you look at it on a rolling year basis, you're still up 4.5%. So still generating positive returns despite the uncertainty over longer time periods. And we continue to see good outperformance over sort of the longer term versus relevant peer indexes.
Just as a reminder, again, the FVAMI balanced peers, just so people, again, from a context perspective, Tom, what does that include?
So that's all the big institutional funds like the industry funds, Australian Super, etc., AMP, Colonial, anything of a similar risk profile, so all the growth funds are in that peer group. So that's your choice of where else you could invest if you so chose. And so we benchmark that, and importantly, we're outperforming that by sort of 2% a year, which is good. Let's deal with Russia, Ukraine. Excuse the sort of busyness of the chart on the left. There's a lot of lines. I'll just point to what sort of matters here. Is that these are basically all the political events, wars, conflicts that have taken place now for going back 50, 60 years, and what happened to the equity market. And it says, if we look at the bottom here, in aggregate, the average sort of sell-off, the median sell-off is just under 6% as a result of the conflict. There's some different, obviously a wide range of outcomes there depending on the environment. But generally, if you look 1 week from the bottom, 1 month from the bottom, 12 months from the bottom, markets have been positive. So in general, you want to buy, these are buying opportunities. However, no one situation is the same. There's certain parallels between the environment now and the 1970s. So that's these events here where you can see actually 6 months, 12 months later, things were worse, not better. And we're not saying that's necessarily the case, but we're just cautious. There's a danger in averages. You need to be aware of the kind of environment that you're in. And so in the 1970s, we also had high inflation and geopolitical events affecting the oil price and major commodity producers. And so similarly, this time, Russia and Ukraine are major commodity producers. This chart on the right is Russia's share of those commodities in global markets, essentially. And so they are 11% of global oil production, 11% of global wheat production, 40% of Europe's energy supply, and they've been cut off from a lot of those markets outside of China and the Middle East that continue to buy their goods. And so it's inflationary, and it's not just energy related. And so the problem with that is that in of itself, it probably didn't matter so much, but we already had an inflation problem, and this is exacerbating it. And so if anything, it means that inflation is going to continue to persist at levels that are higher than central banks want, which means that there's continued pressure for them to increase interest rates. And again, that creates, volatility for equity markets. So, where the average outcome here is suggested we should have bought the dip in February and used it as an opportunity to add risk because it's good, the outlook is good. We've remained cautious in portfolios because we think that this inflation story is continuing to play defense, essentially. Look at commodity prices. So essentially, these are just showing the price moves in major commodity prices. So this chart here is soft commodities, so wheat and corn, which are almost back to record highs. This is energy measured as oil prices, which we're seeing going back to record up to sort of 120, 130 a barrel, and gas prices in Europe, which are up 500% over the last year. We've seen iron ore actually continuing to hold at sort of 150 barrel a tonne, which is good for Australia. Another reason we've done relatively well. And then all the base metals like aluminium, copper, and nickel continue to be at or close to record highs. So it's broad-based, and there's some technical factors that are at play here, and some of that will subside on a resolution of the conflict. There's other longer-term structural issues at play as well, particularly with energy markets. As we move to a zero-carbon world, there's a lack of investment in new oil and gas projects, which means prices are likely to stay more elevated than they were previously. And so, it's definitely something we're watching. What is most concerning is the broadening of this. So it's across all commodities. It's at a really high rate, and ultimately that impacts. It's impacting food prices. So if we have a look at the next chart, there's a strong linkage between the oil price and real food prices. And so I'm sure we're all experiencing this when we go to petrol bowser or to the supermarket. The cost of daily living is going up, and this changes consumer behaviour. So once it becomes consumers expect higher inflation, they demand higher wages, and you risk the inflation becoming stickier. But similarly, it's a confidence issue. It also affects broadly consumer confidence, and so central banks are aware of this, and that's why we're starting to see interest rates go up and their language become more aggressive, because they're aware of the importance of getting it, I guess. So what is going to happen to inflation? That's the big question. There's continues to be pressure. Transitory is definitely not transitory, and about 80% of the underlying subcomponents of an inflation calculation, so food and energy and housing, are all above target rates of 2%. So the core level in the US is now running above 5%, and we think it remains elevated for a little while yet. It will fall over the next year, because without another year of the same level of increase in prices, you can't sustain the same rate. Like, it's a mechanical, it's numbers, it's the math. But so it will fall, which is a good thing. However, it probably falls back to a level, somewhere between 3 and 4% over the next 12 months, which is still well above a 2% inflation target that the US has got, and the 2 to 3, I guess, that we've got in Australia. And all that means essentially now that in the US, we're seeing an interest rate hike at every meeting until this number gets back down to target. And so they're now saying 2% cash rate by the year end. So started at 0 last month and made their first hike this month. 2% by the year end, 3% next year. The Reserve Bank is a little bit behind the curve in terms of their outlook here. The market is pricing in Australia a similar outcome, a 3.5% cash rate by 2024, starting with hikes coming, as early as May. They're sort of not saying that's the case, but they're probably going to be forced soon to play catch up, given the relative strength of our economy and inflation as well.
Do you expect that increase in inflation and obvious interest rates will continue to have a downward effect on growth assets like domestic and international shares?
The interest rate sensitive ones for sure, and we'll show you actually when we go through part of the changes that we've made and the way that we've positioned portfolios is to be more resilient against that. So Australian equities do better because the resources sector does well under the higher inflation environment. So we're overweight Australian equities, for example. The types of funds and styles we own within global similarly have done relatively better preserving capital. So it's not, in a broad sense, yes, you're right, and it contributes to volatility, but it just means we need to be particular about how we position portfolios as well.
It's not across the board.
No.
Yeah.
And so, this is, we looked at this chart again last time. This is the government bond yield, so the cost of borrowing for the Australian government. So the orange line is the 10-year figure, and that's now up at 2.7, an area we think is somewhat attractive and we're starting to buy. But it's certainly, I think when we did our last webinar, we were down here at 1.6. So expectation for long-term interest rates has gone up a lot in a very short period of time. So over 1% 10-year basis in Australia. The 3-year bond rate, which is the rate at which the big four banks will sort of reference their cost of funds to price mortgages, similarly has gone from 0 mid last year to over 2.2% today. And so markets are pricing in a much higher cash rate, whether the Reserve Bank likes it or not, and expect to see variable mortgage rates increase quite a bit in the second half of this year. What does it all mean for valuations? This is really the sort of $1 million question. Last year, 6 months ago, the US, we sort of spoke about, was quite expensive, and so it was 24 times. The pink dot is the current valuation. Blue line is long-term average. And you can see, the US still remains elevated versus historical averages. And that was all justified by lower interest rates. We sort of have always said the market's okay at the current level, provided the outlook for rates stays low. And as soon as that changes, then you've got a problem on the valuation side. And hence why we took all that action late last year and early this year, because the outlook for interest rates changed, and therefore the expensive US market in particular became vulnerable to that change in outlook for interest rates. And so we've shifted a lot away from US, and it's now fallen and starting to get there, but we think a fair value is probably not necessarily long-term at 15, but it's somewhere in between here. So that the US market's probably not got a lot of upside, and there's arguably, 5 to 10% downside potentially. if interest rates continue to rise. Now, it can get there through a combination of earnings going up and it grows into the multiple, and oil prices falling, and it may be just a small combination of the two. So a lot of the heavy lifting's been done. It's come from 24 times to 20 times through earnings growth and 10% and prices falling 10%. And so maybe it's another 5% fall in price and 5% from earnings growth that gets us back to where we probably see value in US equities. And so we've sold, we don't have a lot compared to where we used to sit in terms of US equities. Importantly, there's lots of value in other parts of the world. Europe is sort of in line with averages. UK is cheap. Australia is, where it probably should be given the environment and interest rates. Emerging markets are sort of back to square. And so essentially we took some of that expensive US exposure and spread it around to more better value parts of the world. And that sort of helps buffer the portfolio against higher interest rates. Earnings, so the yellow line is forward earnings growth. We're coming off a period where that was running at above 20% a year, a really strong period for earnings growth. It's now moderating down at about 8% is the outlook, which is still a pretty healthy number. So if you get to a fair value multiple in the market, so valuation, and you get earnings growth of 8%, we're sort of getting back to a level we think where you're going to experience that sort of more long-term return from equities of 8 to 10%, which we think is good, right? It's not all bad news. We're just a bit cautious in the near term. We're not quite there yet, but we're getting into that zone where you probably want to own that. So probably this is back to the earlier question and comment around what does work or doesn't work in this environment, I think. And so,
sorry, Tom, just to interrupt. I've got a question just from your last slide from our clients in regards to Japan, and clearly it's from a valuation perspective, it seems pretty cheap. Cheap doesn't always necessarily mean good. So can you perhaps just give us your view on investing in Japan?
Yeah, sure. So cheap does not necessarily mean good at all. And for a long time, as you know, we sort of favoured US equities despite them being more expensive because they had the earnings. In the long term, ultimately, we think that stock prices follow earnings. And so you need to buy companies that have got good outlook for earnings, profits, paying you dividends. And the issue for Japan continues to be that they've got a really poor, there's some market structure and governance issues, and the makeup of the companies in their index as well means that the earnings outlook for Japan is not as good as other markets, if that makes sense. And so, yes, it's cheap, but cheap for a reason. So if we look at we got here rolling sort of 1 year. Sorry, this is year-to-date returns. So since the start of the year, what's happened over the quarter. You may well remember from portfolios that we used to own managers like Hyperion and even well before that, Magellan. So sort of focused more on those US tech businesses. That's what they owned a lot of. And they were great investments for a long period of time. But just to give you some context on how interest rate sensitive they are and how they've gone so far this year, you can see at the bottom here, Hyperion down 24% since the start of this year, Magellan down sort of 17%. They've been under a lot of pressure. Fortunately, we don't own any of those. What have we favoured? We've moved towards managers which have an average valuation on their portfolio actually closer to here of about 14 or 15 times. So they're kind of conscious of the valuation of the underlying assets they own. So GQG, year to date, down 2%, Hanley down 4%. By no means a disaster at all, and relative to the index down 8.5%, and US equities down sort of 11%. It's a pretty good outcome. So that sort of helped preserve. So to your point, Brendan, yes, if interest rates keep going up, that will pressure, but it pressures this part of the market more than it pressures the broad market, and eventually, so you're not sort of overly concerned by the outside scenario, I guess, just from interest rates, if that makes sense.
I guess it just for the clients' benefit, make them aware. Obviously, Magellan's been in the news a lot of late, but when did we actually get out of Magellan? How long
August 2020. It was a while ago now.
Yeah. So we missed all of what's been happening of late.
Fortunately, yeah. I mean, we some of the issues that played out in the press were some of the things that behind the scenes we could see and were worried about, just through our meetings with them in 2020. And so, yeah, we weren't overly surprised, but it's never nice seeing the press go quite so aggressively.
The throat's is still going all right, mate? Yeah.
All good. I finished the tea, so I'm onto the lozenge now.
Onto the lozenge now. Good.
All good.
Good. Just checking in.
Thank you. The other piece we'll look at here, which is worth recapping on, is you see that line of global alpha or alternatives in the portfolio, and it's a bit of a challenging space. These are strategies which are designed to diversify the portfolios, provide a level of protection through difficult markets, as well as delivering a positive absolute return. And so they've faced their first kind of test in a while, and importantly, we've seen them do their job, which is nice. It's not always the case with this segment of the market. It's quite hard to find managers that do deliver all the time. And so if you look at what's happened here, so this is the World Equity Index down over 8% year to date. And these are the sort of alternatives that you would see. So Janus Henderson, up 4, Sage and Equity Market Neutral up 5, Perpetual up almost 3. So they've delivered positive returns. Again, it's ballast that overall, equity market exposure has fallen a bit, but we did reduce the worst of it and cash, and then you've got some ballast through the alternatives, and as part of running a diversified portfolio, which means when you go back to those numbers over the last 3 months, your balanced portfolio is down 2.5% or something. So it's sort of, that's how we deliver consistency and that downside protection through difficult markets. And finally, sort of how we're positioned today. So the portfolios are overall what we say is neutral. So for the balanced portfolio, that's 50% growth, 50% defensive. However, within that, because of the nature of the mix of assets, so some of those alternatives we just looked at, overall equity risk is 4 to 5% sort of below that. So it's quite conservatively positioned. And then within the mix, an overweight position to Australian equities and an underweight position to international equities is, again, more defensive in this sort of higher inflation environment. Australian equities continue to perform well. International equities are the ones that are suffering more. And so mix of, and then obviously, and a decent overweight position to cash means that, we've sort of got the ballast in the portfolios, the defense in the portfolios. Any questions on that, Brendan? Okay.
No, all good. Thank you.
And we made it. So in summary, look, market volatility, we think, has been driven as much by the outlook for inflation and interest rates evolving as it is the actual conflict, even though the conflict is what's got the headlines. Portfolio activity has increased over that journey to get us into a defensive position and has been more stable since. We think that the conflict puts more pressure on inflation and, in turn, interest rates than we already had. So there's potential more volatility ahead. But there has been some derating across the market from a valuation point of view, and that will present opportunities. But for now, we're still stalking and playing a little defensive. We're hopeful of a resolution soon. There was noise of Zelensky and Putin are sort of looking like they want to do a deal. It's not really going ahead. Russia's clearly under pressure. They're not winning, and that's embarrassing. And they're making noise about saving face, and that's a good thing. The peace talks that meant to take place last night resulted in a few people being poisoned. So I don't know. It seems to flip back and forth a little bit, but I dare say we're probably closer to a resolution than we have been for since the beginning. Yeah, biggest risk would be a big escalation of that. Look, if Putin doesn't get what he wants soon, he starts to lose face back home. And that means he may do something even more rash in terms of the war, and that would be bad, clearly, for markets. But really the biggest risk we think outside of that is a policy mistake from the central banks. They're starting to worry about inflation. They start tightening policy. The minutes of the Federal Reserve that were released last week was indicating they might start going by 0.5% at each meeting and withdrawing some of this, the balance sheet stimulus. That if they go too hard too quickly, they risk tipping the recovery over and the world into recession next year. So we'll just be watching that carefully. For now, economic growth is hanging in there. For now, they're going steadily. If that is the case and we see inflation start to fall, as we expect it will over the second half of this year, and gives them some cover to go more slowly, that will mean that we sort of just go through a bumpy consolidation period this year, and then we buy and look, set ourselves up for good returns for the next year or two, from here. So we use that cash to our advantage, use volatility to our advantage. But we sort of want to know that that's what's going to occur. But now we're worried that it goes too far and we actually need to play more defense. So that's hence why we're sort of sitting and observing and managing the risks at the moment.
Yeah, no, good overview. Thanks, Tom. I do have a couple of client questions if we can.
Go for it.
Hopefully your throat's holding up, mate. But
all good.
All good. One of the ones is around how you think banks will perform if we see interest rates increase, which obviously flow through to mortgage rates.
Mm-hmm.
Obviously, that can increase the risk of defaults. And with that, would that change your outlook on Australian managers in the portfolio or our exposure to Australian shares?
Yeah, it's a good question. In the beginning of this period, when we say it's like when long-term interest rates are higher than short-term interest rates, we say that the yield curve is steep. This is a really good environment for banks to be profitable because they borrow short and lend long. And so to the extent now that their cost of funds are still relatively low, but they're able to start repricing higher mortgage rates, their profitability should increase for the early stage piece. So the household balance sheets are still in good condition, and because we're not in a recession, we're heading for like a 3.5% unemployment rate. Savings are still really high post-pandemic. A lot of people got a lot of cash. Yes, mortgage levels are high across the market. High house prices have forced people to borrow more money. We know that, but we think that the pain threshold for that to become bad debts is still, at least a couple of 2 to 3% higher interest rates than where we are today. And it's probably why the Reserve Bank is going easy. So for this next period where there's a steady increase in interest rates, meaning a repricing of mortgages, which is good for the banks and credit is okay, it's actually a good time to own from a bank investor's perspective. But you're absolutely right. At some point, higher rates means lower credit growth and potentially some default or credit environment that's non-favourable, and therefore it becomes a problem. But we think that's sort of 2 to 3 years. That's a few years down the track. Yeah.
Couple of commodity questions, Tom. Firstly, the impact of climate change and how this may impact investments in soft commodities like your wheat and so on.
Yeah. So if you look at, energy is a big input into the production of agricultural commodities as it is. So obviously you need energy to produce fertilizer, which you need to grow the commodities, but you also need oil to transport the commodities on the other side. And so higher oil prices means higher soft commodity prices. The cost of everything, we think it's sort of something like half of the input cost from a farmer's point of view at the moment. It's gone up 50 or 60%. That's really high. I mean, they're winning because the commodity prices are high, but it's all inflationary, that's for sure. And the transition to zero, to the transport side, eventually, I guess, will get fixed from renewable energy, but the input cost for fertilizer, etc., won't. So they still need gas and energy to go into that. We think that the next 10 years on the transition to zero carbon will be bumpy. There's a real big push to divest from traditional oil and gas and energy projects and not build new ones, despite the fact that the world still needs, at least for now, 80% of the world's energy mix is still traditional fossil fuel. So we haven't replaced that yet. And we need to spend, the estimates are huge, like $30 trillion US to build enough renewables to replace that. That takes time. that in itself is inflationary. And actually, to build renewable energy infrastructure, what do you need? You need oil, energy, copper, aluminium, metals, because you've got to build wind turbines and solar farms and infrastructure. And so it's quite, we think the transition is inflationary, and that's partly, you know, been in our purview, I guess, around how we think about portfolio construction going forward. And there's a big piece of the review that we're doing this year for our strategic asset allocation review. We did a bit of it last year, and even deeper dives into sort of inflation from a transition to carbon and energy price perspective as well.
And your view on gold in this current environment?
Such a tricky one, gold. Would have been nice to have a little bit. It did go up through the conflict. There's a couple of... Certainly we've debated it again, and as you know, we've had it before, and comes and goes a little bit from the portfolios. It doesn't reduce any income. That's a bit of a negative. We can buy bonds now which do. Does act as a bit of a risk-off hedge, and it did a little bit, but not a huge amount. It's gone up, 10, 15. It hasn't gone up, 50%, put it that way. If we were going into an actual World War III, then I think gold would have a really strong place in the portfolio. There's another caveat that has probably kept us on the sidelines a little bit. Russia went into the conflict with about $600 billion worth of reserves, if you will, so central bank reserves, and they've been frozen out of the markets. So their US dollars and US treasuries, and they're unable to trade and get the funding. What they do have is a lot of gold, like $150 billion worth of gold. And so it's the only thing they've got left that they can sell, other than oil, obviously, which they've got plenty of. That in our view, there's some risk that they have to kind of liquidate that to fund themselves, given the precarious situation they find themselves in with reserves. It just doesn't feel as clear cut to us at the moment that gold is a hedge. And at the moment, with interest rates rising, that's generally not great either, because you can buy something that's defensive that actually pays you income, as opposed to gold, which doesn't. But if it gets worse, you want to own it.
Clients like to ask the tough questions, but you did well, mate. And
thanks. Short answer, I don't know on gold. Yeah.
Well, considering you woke up with COVID this morning, I again, on behalf of us and obviously our clients, I really appreciate the time again today, Tom.
Thank you. Thanks for having me.
For our clients, obviously, any questions following this, don't hesitate to call us. We will put this up on the website too, so you can review it again at some point down the track. But until next time, Tom, thanks again, and take care of yourself.
Thanks a lot. Thanks, Brennan.
All
Thank
right.
you. Bye-bye.
Bye for now.